Hello and welcome. You're watching KYC. Now it's a year which will have some of the infra companies in focus, and I'll tell you why. Believe that last year was a little bit difficult with regard to execution on infra as well as new projects coming through because of elections, monsoons, lots of factors, right? And we saw a lot of that play out through FY25. FY26 therefore starts on a note where you have a slightly lower base that you're starting from. There is more traction and wind, and there is also a purpose with which the government is working to ensure that infrastructure companies, and there is a push in the economy through infrastructure again, which has been the case over the 3 years prior to that. So that's why I've picked an infra company, and we've done this company on KYC earlier this year as well. But the numbers that have come through since then have been a little bit iffy, and that's why we've taken it again on KYC. So let's talk about the company first, NCC Limited. Why and what I want to know. First off, I want to also understand that cash flow, which is currently blocked within the working capital requirements of the company, how quickly can it be realized? So the current cash flow is blocked in working capital to a large extent in FY25 versus FY24. Is there a chunky amount which is expected immediately is really what I'm going to try to target first when I'm quizzing management. The second thing is what's the plan with regard to utilizing the excess cash that they have. They have around 1100 crore of cash. Now I understand that there's some amount of debt as well which has gone up. So just understanding the rationale of cash versus debt and what therefore the interplay between those two is going to be, and what's the rationale of keeping both of those on the balance sheet. The third one is what vertical has the best margins. I'm going to try to understand that because that will also determine, as execution starts to play out, how margins will play out. The guidance is around a 9 to 9.5% margin in FY26, but is there an upside risk or bias to that is what I'd like to understand. The fourth piece is how competition is shaping up. It's a highly competitive environment where infra is concerned. You have just about a sub double-digit margin picture, and therefore if competition heats up, you could well see that eating into margins, which could be a concern. And therefore, what's the outlook with regard to both growth as well as margins? So we'll tie all of this in together. But first off, let's understand NCC Limited. And again, why is this company so special is because Rakesh Jhunjhunwala owns a sub 11% stake in the company, and since a while now, so it's not new. And that makes it even more intriguing and interesting, of course, for all of the viewers. Let's quickly tune in and understand what is it that NCC does. It was incorporated in 1978. It's a core infrastructure company now, but it started off as a construction company. Now it does both construction as well as infra. I'll break up the type of business it does, but currently that's how it's placed. It currently undertakes turnkey EPC contracts. I'll break this one up because sometimes in all of the pace of running markets, we tend to forget what exactly is EPC. EPC is engineering, procurement and construction in the most simplest of terms. It's generally used for large complex infrastructure projects where the contractor is responsible for all aspects of the project: design, procuring materials as well as construction, end to end, right? And that's what EPC is all about. It's not a standalone contract for a small construction. It's a larger construction, something like a road from here, from Bombay to Nashik. Now it would cover all tunneling work, all the beautification of the road as well. Everything will be covered as part of that project. It's end to end, and that's what makes an EPC project special. Let's look at the journey of NCC Limited in particular, now that you understood the business that it does. First, it was incorporated in 1978. I did speak about that. In 1990, it turned a public company. It listed on the BSE in 1992. So it has a very, very large history on the index as well as a traded company. It has a turnover of around 100 crore in 1995, turned into 1,000 crore in 2002. Thereafter, journey continued, 5,000 crore turnover by 2011, and you'll see how the ramp up is happening. 95 to 2002 was fairly quick, 10x in terms of revenue. Thereafter, things slowed down a little bit, and revenue thereafter again doubled up, by 2019 at 12,000 crore. Order book touched around 40,000 crore in 2022. When you're looking at the order book currently, it sits at around 72,000 crore, and the turnover currently is around 22,000 odd crore. The 20,000 crore mark got breached in 2024. So that's largely the shape of it. What kind of projects does it do? Now, this is the other piece which becomes important. First is building projects. So building related, it does hospitals, stadiums, educational institutions, residential and commercial property. It does all of that. Then it has water and environment, where it does all of these. Supply lines, including intake works, distribution network, electromechanical work, all of the like, including treatment plants. It literally sets up the entire treatment plant as well. So it has a fairly large range in which it does some work in this area. Now let's look at transport. And this year first we'll focus in on road transport primarily. Expressways, highway realignments, bypass roads, carriageway widening and strengthening, road sections, rehabilitation, upgradation, bridges and flyovers. All of that covered. I did speak about the fact that not only does it have a niche for standalone projects, but larger EPC contracts allow you a lot of these to be coupled together to get executed for that EPC contract to play out. Let's talk about the other piece, which is railways. Earthworks, track linking, railway bridges, overhead electrification, all of that. You're looking at irrigation as well that it covers, of course, along with waterworks. That would be the big one. And it covers all of this, including dams and reservoirs and hydropower. So that's quite large. It does mining as well and helps mine developers. That part of the segment also covered. And then you have electricals, where a large part of it is also about electrification distribution projects in various utilities. It also helps with T&D projects, which is transmission and distribution projects within that power space, which is currently quite big and presents a large opportunity as well. I want to therefore break the order book up. I will talk about the absolute numbers, but this will give you a larger understanding of how the order book is placed, right? Currently 31% is in building projects, 25% in transportation, 23% in electrical T&D. Then you have irrigation, water and mining, which are relatively smaller in size, but 20% combined. So you have 80% of these three, which contributes 80% of the order book mix. And then you have the other three, which contribute just about 20%. Therefore, I'd want to understand how that margin number really shapes up for each of those. But yes, so that's how it is. Now let's look at the rating parameters and let's look at what we will be dissecting. First, I'll be looking at the income statement, the balance sheet, the cash flow, the return ratios, shareholding, street cred, valuations, and street coverage. Valuations is not something we had done last time around on the KYC episode. So that's the new element that we've tried to bring in. And of course, the updated numbers for FY25. Joining me is Anushi Vakharia, of course, who tracks infrastructure very, very closely and who has helped set this entire discussion up. So thank you, Anushi, for that. Anushi, you want to start with the income statement?
Absolutely. As we do, we'll start off with the income statement numbers. You know, we've talked about the kind of order book that the company has, and it's reflecting in the kind of revenue growth, in fact, in the 3-year revenue growth trajectory that the company has presented. Now, if we see FY24, FY25, compare that, and in consolidation take, it's coming up to about 26% of our revenue CAGR. In fact, if you look at the EBITDA also, it's seeing about a 23% of a CAGR growth in terms of how the EBITDA has shaped up. Margins too have majorly remained in the 8 to 9% of range in the last 3-4 year period that we are looking at. This year also the company aims to maintain this in the 9 to 9.5% of range. Net profit about 19% of growth. So overall, a consistent sort of a growth story that we are building in for NCC Limited. It's the order book, which is an interesting one that we are seeing. In fact, in FY25, they clocked in an order book of 71,568 crore. This is in comparison with the 57,000 crore it had over the last fiscal. So it's a strong set of growth that we've seen compared to the last year. Of course, in Q4, there were large size of orders as well, which were expected to be realized in FY26, which we saw coming in FY25 as well. So overall trends in terms of how the order book, how the order inflows, and subsequently how the revenue has shaped up has remained consistent so far. But it's the trajectory in terms of where the FY26 is concerned, where they're guiding for a 10% of a revenue growth is something that we should be asking the management on. Why are we looking at this 10% of a revenue growth in comparison with the 26% of a growth that we'd seen in the last 3 years, right, Harsh?
Yeah, absolutely. So what you want to see, Anushi, is whether that slight drag with regard to execution in the last year or so, if I understand correctly, holds up in FY26, or whether we see a sharp increase or a leveling off in FY26, or when does that happen? Because we've not seen that at least over the last 12 to 18 months.
Yeah.
You want that to kick through. Am I right?
Right.
Yeah, absolutely. So that's how the income statement shapes up. But otherwise, it's looking like a very healthy income statement. Let's look at the balance sheet now. And that's where you'll start to see some concerns, and you might want to tie it up with the way Anushi takes cash flow after this as well. Look at the borrowing number that's gone up. Now, while your absolute borrowing number would have gone up, your net borrowing number has not gone up substantially or doesn't present a big challenge, which is why what you're seeing is not a major concern with regard to where the balance sheet is concerned, but you're seeing a bit of an inch up with regard to the borrowing number. So that absolute number has gone up. Now, I would nonetheless feel that it's a healthy balance sheet. So there's no concern with regard to the balance sheet, but you want to take care of that borrowing number which has gone up. You want to also see how that borrowing number shapes up. Right, Anushi?
Right. In fact, even in cash flows, if you look at cash flow from operations, FY23 and 24, you're looking at a 1,000 crore plus of a figure, which has come down to 742 crore this time. Taking that in account with the EBITDA number, which we are looking at, the ratio is now about 39%. Now, what has led to this kind of a number that we are seeing? Firstly, increase in receivables. Now, this is something that we need to address, not just for NCC Limited, for other infra companies also. How are the receivables going to shape up, and if there would be an impact in terms of where the working capital is that we should be seeing? Overall net cash flows, if we see, that has seen an uptick, however, from 16 crores in FY23 to FY25, this number standing at 436 crores.
Now the other piece, Anushi, is with regard to the return ratios, right? They've not inched up like the way I would have wanted it to. We've seen ROC go up to 15% odd, but you would want, and ROEs are in fact still sub 12, 13%. I mean, while the growth seems healthy on paper, as you can see, but you would want better return ratios from any Indian company, right, that you're investing in. And therefore, that's something that you'll want to wait and watch out for. Also, some of the capital inefficient ways of working, which is large working capital requirements or the increased working capital requirements, which Anushi just pointed out as part of the cash flow, are also the other challenge, which kind of creates a drag with regard to the ROC number. So again, that's the other thing you want to keep your eye out on. Also, the large cash balance that they've kept on their balance sheet, what do they do with it? Because that will also impact your ROE numbers. So those are a couple of factors that I had in mind when I gave this one a neutral, that I'd want better numbers on the return ratios typically if I were looking at NCC as an investment, because you want better return ratios, of course, than a sub 15% in the Indian market. But that's on return ratios. Shareholding, Anushi?
So in terms of where the shareholding is concerned, promoters, there's nothing to complain about here. It has remained, in the last 3 years, it's remained in that 22% of range that we are looking at. Overall, we have given it a neutral rating because of the FII change that has happened over the last 3 fiscals. So if you see 20% of this mix, which was that has now come down to 14%. However, DIS have picked up stake in the company, which stands at 16%. Public continues to hold about 45 to 48% of a chunk in this company is what we are seeing.
Okay, street cred, let's quickly go to that one. 1 month stock is up 6%, but you look at the 6-month chart, not looking good, down 25%. In fact, the stock fell 33% from its highs at the start of this year, and thereafter has made a decent recovery as well of nearly 30%. So you've seen this kind of flip-flop in terms of the stock price, but nonetheless, there has been some pressure in the near term is how we would assess it. But over the longer term, when I'm looking at the 5-year chart, the stock has done phenomenally well. It's been a 7.5 bagger. So no complaints there. We'll give this one a neutral therefore.
Okay. In terms of where the valuations are headed, you know, in the current P, if you are looking at that is 70 times. We took the 1-year forward P is also, that is around 12 times is what we are seeing. Comparing that to the 5-year average P, 14 times, nothing majorly out of line that we are seeing, in line sort of a number in terms of where it was before. While if we compare it with the peers, now that is at 12 times of stress. So comparatively higher in terms of where the industry average is concerned. So that's what we are looking for valuations.
Okay, so that's on the valuation count. Mind you, this one makes a profit around 800 odd crores. So I'd want to know where growth goes, where profitability goes, and therefore how the forward price to earnings looks, because price to earnings as such is not looking too expensive. Let's quickly look at also what analysts on the street are saying. Most analysts build in a buy call with a 16% upside, and therefore we're giving this a clear thumbs up. Not really discussing that in too much detail. But let's quickly look at the final ratings. How does it look? What rating does an NCC get? Let's quickly have a look. Income statement, thumbs up. When you're looking at balance sheet, also thumbs up. Cash flow is a neutral. Return ratios is a neutral. Look at shareholding is a neutral. Street cred neutral. Valuation neutral. Street coverage thumbs up. So while it gets just about a 5.5 out of 8, what I'd look at as a possible positive is the fact that it's got no thumbs down. So that's the other piece. Let's quickly go across though. We have the management waiting for us. We have Neerad Sharma, who's the head strategy of NCC Limited, joining us. Sir, talk to us about how FY20. Firstly, a very good morning to you. This is Hersh here. So I want to first start off by asking you what's the outlook like with regard to capital which is blocked in working capital, because that's the key concern. Your profitability has gone up for sure, so no concerns there. Growth will continue to be steady, it seems. Order book is very healthy. The only concern is with regard to working capital. What happens there?
Very good morning, Harsh.
Good morning.
At the very outset, I take this opportunity to congratulate you on a very good coverage.
Thank you
You have
so
been
much.
able to highlight all the important parameters and the performance of the company, not only last year, but in the last 5 years. So I really appreciate that very much.
No, sir, thank you so much for that.
Coming about the working capital, primarily it is a reflection on two important factors. Number one, this is generally the situation prevailing, across the companies. This is something that has to do with the sector as a whole. I mean, primarily the people who operate in Indian infrastructure market. The second thing that I wish to share with you is the fact that it is also a reflection of the fact, of the unusual nature of FY25, this year, the last year, that year has been unusual in more ways than one. I take this opportunity to list few of them. The last year, FY25, has seen central government elections. The impact has been not only for about 3 months, what we anticipated earlier, but the impact has been primarily, let's say less than little 2 quarters. Then followed by, we have had state government elections in few key states like your state Maharashtra. So whenever you have these big events, generally they will have some bearing, some reflection on the working capital blockage. And this is not really a statement of NCC only, primarily as I shared with you. This is the situation prevailing, but we are hopeful. We are hopeful that, situation should improve now. I also take this opportunity to share with you the fact that we have received some of the payments in the month of April.
Mr. Sharma, apologies for interrupting, sir. So therefore, will the unwind happen this year? You're saying that there were certain election-related headwinds last year with regard to recovery. Will it happen this year, therefore? And how quickly?
Hopefully, see. Harsh, you and I cannot really, take a call on this. this sector, most of the projects in the infra space is something that is announced and implemented by the government agencies. So at the end of the day, we are hopeful. Let me first say that we are hopeful. But it is very difficult to say with 100% certainty that this is something that things are expected to pan out. We are hopeful. This would be a reflection on the payment release pattern of our several clients. But as we speak, we are hopeful.
This is Anushi joining in. Now, if you're taking the long-term in picture, we've seen about a 26% of our revenue CAGR for the company. This is in the last 3 years that we are looking at. In fact, in FY25, you had originally guided for 15% of a growth, which was narrowed down to 5%, which you outperformed with a 6.5% of a growth. Going forward in FY26, wherein you are seeing about a 10% of a growth, do you see that this is on the lower side comparatively? If yes, what's the reason that we are guiding for a 10% of a growth and not a higher number?
Very good question, Manushi. Good morning.
Good morning.
Firstly, the base itself is a little bit on the higher side. If you just increase any number mathematically, discounting for a moment whether this is PAT or revenue, by, as you said, upwards of 25% CAGR, the base itself becomes little bit on the higher side. The second thing that I wish to share with you is the fact that you are right that we are sitting at a very healthy order book, upwards of 71,000 crore. But bulk of these projects, let us say about 60% of the projects that we have been able to bag in FY25 has really come in the last quarter, and not only in the last quarter, in the last month of the last quarter, that is in the month of March, we have been able to bag, about 20,000 odd crore projects. The point that I wish to share with you is, there is a gestation period when the projects are awarded. It is not that these projects have to, cross some very important milestones, For example, we will have to, sign the contract. We need to mobilize. We need to make sure that all the ROWs, what we call right of ways, all the permissions are in place. Then we start the execution. And even if we start the execution in most of the contracts, you will have some kind of, milestone to recognize, the revenue and margin. So that is the reason the guidance that we have shared with you appears to be a little muted. But if you really dig deep, you understand on what basis, we have decided to share this guidance with you. I
Right.
hope that answers your question.
Yes, absolutely. So, Mr. Sharma, just a follow-up on that, considering, that we've seen a lot of these orders coming in the last quarter itself. These are the high-ticket orders that we are seeing. I just want to understand, what's the kind of inflows that we'll be expecting this year, and from which segments in particularly you're seeing higher orders coming in? If you can give us more clarity on the execution side of the order book and the inflow side.
For the FY26, on the inflows, I am pleased to share a guidance with you, which is already there on your screen, 22,000 to 25,000 crore. So primarily, this should be bagged in 3-4 important business divisions that we have, namely buildings, transportation, electrical, T&D, and water. Primarily from these 4 divisions.
Okay, so talk to us about the capex plan for FY26. I understand that smart metering will take up some amount of capex. I also understand that you're buying a TBM, which is a tunnel boring machine, which is also going to take up some part of the capex. How do you fund this? Debt has gone up. How does the debt shape up therefore?
For FY26, the capex that we have planned is, about 700 to 750 crore. And you are rightly, we have bagged one project, GMLR. It's a tunneling project for which we need to purchase one TBM machine. So for this machine, we have already placed the order, and the machine is expected to come very soon in next couple of months. And this TBM machine would be thoroughly expensed, for during the duration or execution of this project. So the point that I'm trying to make is, this debt would not be a conventional debt. The capex that would be incurred on purchasing this TBM machine would be totally expensed during the execution of this, GMLR project.
Okay, so considering the overall debt picture in mind, in the con call, it was mentioned that there would be about a 200 to 300 crore of an increase every year. Just want to get more clarity on the net debt positioning that the company would see. Is the debt to equity ratio expected to see a pickup?
For the FY25, this ratio is 0.2. And, as you rightly highlighted, the company has been growing at a fierce pace, upwards of 25% CAGR in last 3 years. So to fuel this kind of, growth, definitely you need working capital. And in some projects where the payments are not coming on time from our clients, we prefer to continue to, commit some working capital for those projects. So that is also a factor that is at play. But I also take this opportunity to pinpoint that most of the debt that we have is primarily working capital, right? Working capital kind of debt.
Point taken, sir. Mr. Sharma, I want to ask you, give us, okay, so FY26 may not be a year which enthuses you in a significant fashion, at least in terms of commentary. Give us the thought process in the next 3 years, because that's when you'll execute your full 70,000 crore of order book, would be my guess. What is the kind of margin number on that full order book that you look to clock? And therefore, what is the profitability maybe over the next 2 to 3 years? What is the growth looking like in terms of profitability?
The first part of your question is about execution of, more than 71,000 crore order book that we have. You are absolutely right, By and large, we should be able to execute substantial chunk of, this order book in next 3 years. It is very difficult, really, Harsh, to talk about, the revenue and the profitability for the next 3 years. The way we work in our industry, in our company, generally we talk about, 1 year, and I have already shared, the guidance for you for the FY26. What happens, Harsh, is, we are executing a lot of projects, about 150, 160 odd projects. Each of these projects that we have will have some kind of, milestones, some kind of, execution, guidelines, the payment guidelines. So it's not always a choice, For example, let me extrapolate that a bit. Let us say that we have a project that, we want to complete the project in 1 year's time, but the client may not be willing, The permissions may not be placed. The client may not have all the budgets, to complete project ahead of the schedule.
Sure.
All the clients, they have, yearly kind of allocation for different schemes, different projects. So at the end of the day, whenever possible, given a choice, everything, being in place, we would prefer really to complete all these projects ahead of the schedule.
Point
but
taken.
It's not always our call. It's a partnership, right?
Point taken, sir. Point taken. Got it, sir. Thank you so much for joining us this morning and giving us that perspective. But that's unfortunately all the time we have. That's all. In fact, thank you so much, viewers, as well, for joining us and for going through this one. From Anushi, myself, and everyone who puts the show together, thanks so much for watching. More action on the other side.